and welcome into Making Sense. Since about 2000, 2008, 2007, in that era, we've been saying, gee, I wonder when things are going to turn around. Well, each year we keep saying, well, maybe we're going to be doing a little bit better. Now we're into 2015, and I still think there's a little doubt in many people's minds. So, to erase some of that doubt, I brought in Brandt McDonald, the principal of McDonald, Barranco, and Hagen Wealth Management.
All right.
And you guys have been, your firm together as that group, been together, what now, over 20 years?
Yes, that's right. And I've been managing money now for 26 years.
Wow.
So, yeah, time flies when you're having
teenager,
fun.
Didn't you?
Exactly, yeah. So, and a lot's changed over that period of time.
Oh,
you
it
know?
sure
But
has.
one thing that hasn't changed is sort of the constant worry and concern about what's happening in the world and geopolitical events, global economic issues, so on and so forth. And you know, it's funny because you mentioned when you just said, you know, how are we doing and are things getting better? And I think at the end of last year, one of the messages that we tried to clearly articulate to our clients, and even on some of the other media outlets that I participate in, was the idea that, you know, there would be some repercussions from the Federal Reserve ending their quantitative easing program, because there was some argument out there, some in one camp who said that the Fed is clearly 100% responsible for all of the positive market growth we've experienced. Then others said, no, there really are some underlying positive fundamentals that are going on that are lifting prices. I think it was probably a combination of the two. But at the end of last year, when we started to contemplate the Fed ending their QE, we felt strongly that that was going to be a headwind that we would all have to face. And so what we said that we expected for 2015 would be an enormous increase in volatility in the markets, that we would probably struggle a bit, particularly from a fundamental perspective, because of a few things. You know, the dollar began to rally as Europe and the rest of the world was so weak, and now they've embarked on their own sort of money printing exercise, or QE program, if you will. And so with this strong dollar, it started to create more headwinds, and now we've seen this first half of this year, sure enough, that's what we've gotten. I mean, first quarter GDP growth came in at 0.2% positive growth, and now everyone is saying that's going to be revised down, and most expectations are that we think it'll probably somewhere around a negative 0.5% for the first quarter. Now, that's not good.
No.
The second quarter GDP estimates from most Wall Street economists was that we would probably see somewhere around a 3% positive growth, a massive rebound. Well, now all those numbers are coming down. Those projections are coming down.
Isn't it down around 2 right now?
Most of it has come down around 2, but you know, I've seen projections as low as, you know, 0.3 to 1.2 range, and who knows where we're going to land up on that. But I think the clear bottom line takeaway is that primarily when you have a runaway dollar like we've seen, because 3 years prior to that, the dollar did nothing but go down because the Federal Reserve created all of this new money. They were attempting to monetize the debt, decrease the value of the U.S. dollar, and they successfully, you know, they were successful in that exercise. But now that they've stopped and the rest of the world is printing, then you would naturally expect the dollar to go on a tear, and it did. And when that happens, it impacts two primary things. One is large U.S. multinational companies who are trying to compete overseas. They've had a real hard time. They're in markets. They've seen some weakness there, not just because of the weak economic backdrop in Europe and in Asia, but also the headwind of the strong dollar, which is a negative if you're trying to export overseas. And then secondarily, I think, too, that when you look at U.S. domestic issues, as the threat of rising rates could come about because of this dollar strength, that causes some pause, not just in the consumer's mind, but certainly in small businesses, because they're trying to project and lay out plans for, you know, new things like property, plant, and equipment and projects for the year. So there's a lot of uncertainty there. So certainly it's not a surprise that we're seeing weak growth in the first half of the year. I think that if we can ever get through this interest rate issue, you know, and if the Fed could actually move off of the zero interest rate policy, or ZIRP as we call it. If they could get out of that, I think it might, sort of clean the runway up a little bit, that we could do some positive things the second half of the year. So the bottom line is, we think that for 2015, we think that we will see some growth in the market, but it's going to be well earned, and everyone will look back and go, wow, I'm glad I was strapped in, because that was a volatile year, So I think all in all, not a great story to really tell at the moment, but it's not terrible either.
That's right.
Yeah.
Well, Brent, you've been doing some time in New York with
Yes.
some of the big boys up there, and we're going to get you to come back next couple of weeks and give us a little bit of a peek underneath that tent.
Yes.
To see what some of the thinking is from the financial capital of the world.
That's great. I would
Okay.
love to.
And we'll be right back right after this.